Wow, there's no easy way to put it. Friday's labor report was downright disastrous for the broad market. Now pair that with a weekly trend threat and numerous risk-off indications starting to fire, it's not looking great out there. Welcome to the Trade Brigade Weekend Show. My name is Matt, and in today's episode, we'll start with a really high time frame perspective and progressively drill down to reveal more and more pain points in this market. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So the story begins today on the SPY monthly time frame chart, and I just want to be very clear that we're looking at July's bar now that it's closed out. It's the green inverted hammer. So from a structural perspective, what would this suggest overall? Of course, in the upper wick, we know that sellers really stepped up towards the top end of the monthly range, and they were able to push prices back down towards the opening print, but not under the opening print. We do still have technically a green-bodied bar here. So it's certainly worth acknowledging the sell-side pressure in the upper wick, and as we can see in the beginning stages here of August, we are underneath the low of that bar. Is it reasonable that a monthly pullback could unfold? I think the answer is somewhat yes. Now, on the monthly time frame chart, this sort of brings us to our next point. We're pulling back from the highest high in the monthly trend count. Again, let's focus on the bar from July. On the bar-to-bar count, it technically made a higher high as well as a higher low. So the trend here is certainly up. We know these to be all-time highs as well. And if the monthly time frame chart offers a very shallow pullback, if we just stop right here in August at the top end of this prior range, which is roughly around 524, we'll get more granular on the weekly in a moment, but what an ideal opportunity for a higher low. Now, as we mentioned in the intro, it doesn't look like we have everything firing on all cylinders. Oh my goodness, this is a great dip buy opportunity. It doesn't look that way, but let's also take a moment here and just recall that this is a soft monthly higher low. We never flipped into a weekly downtrend over here and set some sort of major lower high. It was just 3 weeks down in April, and then it was straight back off to the races. So what I'm getting at on the monthly time frame chart is really that from a higher time frame perspective, it feels like this is a very aggressive pullback because we've been used to this grinding trend in the upward direction. But really, in the grand scheme of things, structurally speaking, it hasn't unwound a ton of progress on the highest time frame monthly. Once again, this is a 90,000 foot view. If you're a longer term investor, you should be thinking, great, there's an opportunity for potential support here. If the market holds on, awesome, we remain within an uptrend. Even if we pull back, we could set a firm higher low on the monthly over the previous all-time high that was set just before the calendars flipped to 2022, right? And that level is going to be closer to 480. So on the highest time frames, I'm not seeing a huge concern here. Yes, we're pulling back, but structurally, nothing is broken. And we could even come in here with a fib, right? Because fibs always make our job easy. We'll come in from the bottom up to the top. I mean, your 38.2 Fibonacci goes directly to the previous all-time high at 480. So if this is going to be monthly bull flag consolidation, from this perspective, point A up to point B, there's nothing wrong with a deeper pullback. Again, it's not going to feel comfortable in your long-term portfolio, but structurally speaking, over 480, there's not much to worry about yet. Now, let's get progressively through some smaller time frames here, and this is where things start to not look as great. So on the weekly time frame chart, as we get more nuanced, you can see on the bar-to-bar count, let's do our classic candle structure and location. We've got it's a large-bodied inverted hammer, right, where the upper wick is certainly larger than the lower wick. There was a pop to the upside that completely failed. We moved through the opening print for large range expansion in the downward direction and basically closed extremely weak. Not dead on the lows of the range here, but certainly in the lower third of the weekly range. So sellers are in control when it comes to both structure and location. You'll note on the bar-to-bar count a lower high as well as a lower low. But on the weekly time frame, and we've been talking about this for, it feels like forever now, we've made note that pulling back from this higher high, just like the monthly, we can still afford a higher low on the weekly time frame. And the line in the sand that I've been using, we talked about it in last week's episode, is right here, right now at 532.50. We'll see this on the daily chart in just a moment. I've got it labeled out for us, but the main concept is that we want previous resistance to potentially act as newfound support. Now, if we just add up what we discussed, that candle structure and location, bears go 2 for 2 on the weekly, it doesn't look like a convincing argument that the chart is just going to reverse and suddenly see this big upswing here right back into new all-time highs. However, let's look to our left here a little bit. what did this bar look like, and then what happened after it? I'm not saying it has to be a rinse and repeat. I'm not trying to be overly optimistic. As of right now, the data does look like, and as we continue through today's video, you'll see this as well, it doesn't look good. It looks like more pain is on the horizon. However, if the market tries to rally off of this, the next major watch, I would argue from the higher time frame, is to determine whether or not the weekly sets a lower high around this 550 area. You guys know that we've been obsessed with 549.50 if you want the nuanced level, right? The fact that we are underneath that now means that there's an opportunity for a weekly lower high, and that could also change the trend. So two things to focus on here out of the weekly time frame. Either number one, we do not hold previous resistance, we make a more meaningful lower low, and I would argue that the trend is at least neutral down at this prior low, if not flipping to down already, or on any rally attempts, sustained resistance here at this 549.50 is also a great chance for the bears to change the weekly trend. So in the intro, when I say there's a threat, this is exactly what I mean, that the market could go either way here, and there's an opportunity for the bears to prevail with a trend reversal. Let's check in on some of our more meaningful indications like the Fibonacci's from low to high of this move here. Notice that the 38.2 is no longer holding like a gem. It's not, ideal consolidation would have been this lower wick was it, and then we're just consolidation here, aiming for the equal high. We're not getting rainbows and butterflies from that perspective. If we come in here with the anchored VWAPs in the weekly time frame, we're right at this one and clearly under this one. So at this point, again, the 550 zone, if there's any sort of retracement and we don't even make it to this level, if there's a rejection here, then what's the next setup on the weekly? It would just be an equal low flush. Something that looks like this is a short through this low for continuation in the downward direction, likely targeting the 61.8 and previous structure in here as well. Prior set of highs, closer to that monthly higher low zone, right? That's exactly what we were just referencing, around 524. I mean, it looks, we're sort of splitting hairs, right? On the monthly chart, there's a lot more wiggle room here at the axis, but you get the point. So that's what the threat is on the weekly time frame. If we come in here with the volume profile as well, because this has been very insightful for some thin volume rotations, right? We sort of made note that underneath, not last week's low now, but the previous week's low, there was this low volume void. And where do we find ourselves currently? Coming into that area. So this is a monthly area of support. It's that, again, let's just round up here and call it 525 for round number's sake right now. If we can hold this, then fine. This is like picture perfect rainbows and butterflies on the monthly. Maybe you could argue that the weekly is trying to hang on to hope. But if this high volume node now is going to act as resistance overhead and we get this, that's that threat that I'm really sort of anxious of as we start to look and peel back the layers of the onion and see different indications that are certainly suggesting that sellers are getting a little bit more active here in a more meaningful way. So let's drop it on down to the daily time frame chart. On the daily time frame, we always begin with this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. It's this box right here. If we're contained by the upper bound, the number is loosely around 546 15, 16, and that's a huge opportunity for a lower high. If we're counting trend here on the daily, we have highs, lower highs, and technically we set a lower high on that Wednesday-Thursday session combo at 554.50. So this is suggesting another lower high in the sequence, keeping the daily trend down. Because if we're looking at the lows, we certainly had an attempt for lows off the top end of the balance range from back here that did not hold. We talked about the lower low here and the fact that the daily trend was already down. And on the Friday session, of course, this speaks for itself, we made a lower low. So the expected move low this week is at 519.57, and that's also a massive lower low in the trend count. Weekly expected move does strike me as being bearish. If we just sort of walked through trend, we're sitting on the lowest low of the trend cycle right now, which really leads me to believe that there's two things that can take place that still keep the market bearish on this smaller time frame. If the market's going to continue in the downward direction, great. Lower lows keep the trend down. That really speaks for itself. One thing that I would be paying attention to here would be a failure through Friday's low at 529 would unlock a sort of range rotation from back over here into 523. And this is that monthly line in the sand. I could probably come in here and let's relabel this together. Let's just quickly do this. Monthly. Monthly. This is what happens when you do it live. Monthly. There we have it. Higher low. Let's pop that on the right, and that is a zone to at least be mindful of as well. This is the weekly higher low zone that we just saw. It needs to hold right here, right now, and then what's the threat? As we were just saying, and we've actually adjusted this slightly lower, we were talking about 550, 547 is that weekly lower high. So if we're just going to be congruent, and I apologize for not doing my homework ahead of time, could have put some labels on here, but let's go weekly, and then we'll go LH for lower high. Let's pop that on the right. And this is just going to give us a good framework of the level, the higher time frame levels that we should be mindful of. But back to the daily trend sequencing, hopefully I didn't lose you there. If we see a counter trend rally on the daily, the first thought process should be for a gap fill reversal. I mean, you could try to participate long on this move saying, oh my goodness, the market's oversold, it's an overblown move to the downside, it's got to see a little bit of a reprieve rally. That's fine. And we do have ourselves a hammer candle structure on the Friday session, which technically closed underneath the bottom end of last week's expected move. So if there is going to be a counter trend move, that's fine. But once again, at the gap fill reversal, so that's over 537, Friday's high, into Thursday's low at 539.50, I would be looking for a daily lower high right here, and any reversals off of that, it's game on. We're trading right back down into the equal low at 529, and then the equal low breakthrough is the rotation we were just describing into the monthly higher low at 523, right? And if I just zoom out on this chart, you can see if I extend this, 523 off to the left, this is why it's that area, correct? So all set on that indication, and that is your downside out of the S&P daily time frame chart. Again, totally acknowledging the hammer candle underneath the bottom end of the range, look above and fail. The next step is really just to set either a gap fill reversal lower high here and continue to the equal low and then a breakthrough, or if the market continues, still an opportunity for that weekly high, lower high, to be set right here at that 547, the top end and failed breakout point from the Wednesday session. You'll notice on the selling pressure, volume is also increasing here, indicating that this is very emotionally driven. Everybody is panicking. There are not many safe havens here outside of bonds and utilities, which we'll talk about as we get into some more of the supporting evidence today. The next thing we'll do is just come into our alternate drawing set to acknowledge that this was a perfect backtest of the support trendline breakdown here. It was also, if you recall, this was sort of acknowledged in the Wednesday update video. It was the 20 SMA, the orange moving average on your screen. So we've certainly fallen away from that. The bears are in control. I mean, this was a huge bearish engulfer on that Thursday session. It's hard to ignore the selling pressure and the change in tone out of this market. Recall, and this is important, right? Because the types of participants in the market dictate how we participate intraday. When we were in this grind to the upside, we didn't have any semblance of stronger sellers really starting to participate. The first sign of things was when this gap down happened on Tesla and Google earnings. And then after that, we're seeing this reinforcement of stronger sellers emerging here in the market. And on the daily time frame chart, right? Just from a very simple pattern perspective, here's your head and shoulders. We're now underneath that neckline. Any lower highs that are set below, that's bearish, right? There's no doubt about that. That is a bearish setup here. Let's take it on down to the hourly time frame chart and see what else we can see. So let's play the what if game to truly reinforce, again, the participant type in this market. On Wednesday's session during the FOMC, if everything was going to be fine and dandy, the breakout through this set of highs should have yielded a higher low above 547 for continuation back up into the equal high, if not some sort of attempt back to the all-time high. It seems crazy to think about as of right now after the Friday labor report, but that's what should have happened if stronger dip buyers were truly going to step up. So as we talked about on Wednesday, our arbiter of price, our judge, 547, having offered absolutely zero, zilch, nada, nothing in terms of buy-side support on the hourly bars here, that instant right there is when you should have changed your tone and said, you know what? This is not a reversal. This is just nothing more than a lower high. It's game on for the bears. So as long as we're below that 547, I think that remains the case here. You could also build the argument that a more nuanced lower high could be produced right here off of 543.20. 543.20 represented this consolidation which failed. So in theory, this is where the sellers had their edge prior to the Wednesday gap up. And then you can see into the afternoon on Thursday, that rejection as well. Daily 50 SMA in blue here as well. If that nuanced area also is tested, you could see a lower high here. It doesn't have to get to this 547. So the point being is that on the smaller time frame charts and even on the daily time frame chart, sort of our medium time frame here, the bears are in control. If we get a rally, you should be thinking about bears here, you should be thinking about bears here, and you should be thinking about bears here. there's really no stronger argument to be made about a stronger daily trend reversal that we could participate in unless there was going to be some sort of inverted head and shoulders that then starts to brew, which would require the pullback first anyhow. We would be bearish here anyhow. And then if there was a higher low, huge speculation right here. And again, as we walk through the supporting evidence, it seems unlikely that this would be a top of mind priority, especially over the span of this upcoming trading week. So that's what I'm seeing in terms of our map. If the market is just going to give you totally bear flag consolidation here, the flush is underneath 529, trades into the monthly higher low zone at 523. Anything beyond that is the lower edge of the weekly expected move, and we'll update you on Wednesday if it's required for any targets below. That's at 518.75 technically if you want the structural element. One final thing I would say here about the hourly is that technically speaking, there can be a Stevie Wonder trade here off of the open on Monday. If you get some sort of opening drive out of this bearish consolidation, I think you pinch out some shorts who are late to the party. But again, the whole point of this exercise, walking through the multiple timeframes and especially on the daily chart, recognizing the change in tone out of the market here and here, is that sure, you might get a little bit of a short squeeze pinch from those sellers late to the party, but as soon as we come into structure, you should abandon the long thesis basically and say, hey, unless there's a structural shift, my ideas here are scouting lower highs on the hourly time frame chart. What are we seeing when we bring out the Fibonacci's from the all-time high down to our most recent low? Notice that your 38.2 is spot on with that nuanced level we were just describing at, technically we were talking about 543.20. This is 542.82. Let's not split hairs. This area right here, possible lower high. The other thing to point out is that the 61.8 would need to be recaptured if I was going to argue that new all-time highs were like right here, right around the corner, and this was a strong reversal. Obviously, there's plenty of areas for the market to reject below that 61.8 when it comes to structure. Namely, I'm thinking about the weekly lower high threat at 547. And then we'll finish it off here on the intraday with our VWAPs, just pointing out great confluence from the all-time high with the weekly lower high threat, 547. So again, just reinforcing these levels here. And then this gap fill reversal area is top of mind early on in the week. This is the anchored VWAP from the Thursday session when we got, just nastiness, bearish engulfer, big change in tone, big change in sentiment out of this market. If we want to reinforce sentiment even further, look no further than the market internals. Check out the video tutorial in the top right-hand corner if you're not familiar with this dashboard. However, I mean, this is horrendous. Look at the volume outflows, not only on Thursday, but Friday's follow-up, even as the market's just consolidating sideways into the close. What this would tell me is that there was nothing at the exchange level on the NYSE that was even remotely close to getting back to neutral or over the previous day's settlement price. Everything was below. Huge volume outflows, well underneath negative 500 million net flows on the week there. If we look at this box right here, if we take a look at the advanced decline line, huge slide on the Thursday session. Big sort of trend lower zone reads on the Friday as well. One thing to make note of is that on Friday, the index score actually moved higher here, and this would support the Stevie Wonder counter trend move possibly happening first. So on that gap down day Friday, it's not like things actually deteriorated into the close. They sort of more so had the gap down, saw some early morning pain, and went sideways through the remainder of the afternoon session, not making new lows into the afternoon. That's what this small divergence would suggest. Once again, the counter trend is this oversold. That's what that sort of would lead me to believe. Similar indication here out of our cumulative tick. And FYI, it might not be by the time this video goes live. However, this should be up on the website this weekend. Check it out. I'll make a more formal announcement in the pre-market show on Monday. Let's go on over to the market profile and see what else we can learn about the ES futures here. Just pointing out the, again, emotional nature, the change in tone about the types of participants in this market with the single prints and thin volume at price when the market's breaking down on Thursday. The value area and point of control moved to the lower 50%. The point of control is technically higher here. I'm honestly surprised it did not move all the way down to something like here. Regardless, you can see on the Friday session, we're also getting value area and point of control lower in that individual session. This poor low was gapped through, so if we do tag it, that would qualify qualify as a repair there, which is just the gap fill reversal indication we were describing on the daily time frame chart. Anyhow, there's really not much to read into here other than all of this consolidation is clearly now overhead supply. There was a little acceptance on Wednesday, none on the Thursday session. There was no attempt for buyers to step up here, no attempt to try to build out value there. So with this, right, we're just reinforcing, I know I've said this a number of times now, but the change in tone needs to be clear here in how we actually participate. We're looking for and scouting for lower highs now that dip buyers have clearly raised their hand and said, hey, we exited stage left. We're not here anymore. If you're not familiar with the market profile, by the way, check out the video tutorial in the top right-hand corner. Let's continue back on over to the platform here and check in on the nasty NASDAQ, see what's going on with the NASDAQ through the lens of the QQQ Cash ETF, and we'll go on up to, let's start with the monthly time frame chart. We'll do it justice like we did in the S&P 500. So, monthly bar in question is the second one in. This is the beginning stages of August. We've definitely got an indecisive doji. I wouldn't qualify it as much so an inverted hammer simply because of the size of the body and the lower wick there in combination. So, it's definitively bearish, and a huge difference that you can see, I mean, this one should just be jumping off the page, is that the bar of the body of the bar, there we go, is actually red instead of green. So what that suggests is that not only did sellers step up near the highs, but they were able to push prices back down to the open through the open for some range expansion on the monthly chart here in the downward direction. Now, obviously, August is starting to break down as well. We'll get more nuance, but just like we done on the S&Ps, right? The bar-to-bar count is a higher high and a higher low. Technically, we are pulling back from the highest high in the monthly trend cycle, and this location right here, right now, out of the QQQ, could offer a monthly higher low. So if we could support this, and the level in here is at 4, let's round off, let's call it 445. If we're over 445, nothing to worry about on the 90,000 foot view. Again, this is like for investors. This is not really as relevant for day traders, but sentiment-wise, investor-wise, I don't think that I would be throwing in the towel. If you look at the 38.2 here as well, it's right up against your previous all-time high, closer to 408, the round figure, which is the April pullback low. So monthly chart is all set here, would not be overly concerned yet, but as we continue through the time frames, of course, all the similar cracks start to emerge. So this pullback, obviously much more aggressive than what we saw in April. The bar-to-bar count is definitively bearish, huge red-bodied bar, a little bit of an upper wick there, not much of a lower wick, very similar to the S&P 500. You've got yourself a beautiful consecutive set of lower highs and lower lows coming directly into this area we were just describing on the monthly, which would have been that key higher low. Well, on the weekly time frame chart, your key higher low wanted to be over previous resistance, trying to act as support. We violated and closed underneath. So, is the weekly trend down yet? I wouldn't argue it's down yet. You've got sort of an equal low to this pullback right here. But of course, the threat now just becomes, and this is it's almost been cemented on the daily chart. We'll see this in a second. But if the weekly rallies up against this level up here, and to give you the number, it's loosely that 475 level. If we reject that for a lower high, huge opportunity, and pattern traders are maybe starting to envision this. There's your head and shoulders, break some sort of trend line that might look like this, and you could imagine how that triggers a weekly trend reversal. So the threat is even more imminent out of the QQQ weekly. To me, it seems as though the lower high probability is far more elevated in the NASDAQ versus the S&P 500. Not that it's not elevated to begin with in the S&P, but more so on a relative basis here. Let's jump on down to, actually what we'll do is, of course, I'm getting a little ahead of myself. Let's throw on those weekly anchored view apps. We're underneath both of these instead of sort of more so offering a flush opportunity underneath one. This, of course, is still an issue coming from this pullback low. If we break that, the target should be down here on the weekly, much closer towards that 420 area, and this is providing confluence for resistance around the 475 zone we had just described. If we come in with the fibs from the bottom up to the top of this move, well underneath the 38.2, sitting right here right now on the 61.8. Again, this is like do or die out of the NASDAQ. It needs to hold this structure, that 445. We just saw it on the monthly, on the weekly. You can see it's the anchored view app. It's the 61.8. If we close weekly bars below that, I mean, just odds of a 100% retracement really start to go up under that sort of circumstance. If we check in on the volume profile, again, it's not going to be a shocker here, very similar to our S&P 500, but let's zoom out on this. And as we look left, This shelf is the high volume node. This is that rejection point for the lower high at 475. If we look at this is the do or die level. It's right here, right now. It's the high volume node, right? So these two key areas, if I had to simplify the higher time frames here, it's 475 possibility for a lower high, and this area right here, 445, possible opportunity for a higher low, but probably from a monthly perspective, not a weekly perspective, right? So this would be your weekly lower high over here. All right, that's the higher time frame. Let's get more nuanced on the daily. We'll evaluate the weekly expected move, the whole 9 yards. So we've actually got to do some manual adjustment here just so we can fit it all on the screen. That's how volatile this market's been. If you take a look, this is our box. If we're contained by the upper bound, the number's at 464.41, offering a clear opportunity for a lower high. And of course, if we continue to the downside, just the very obvious lower low, and that's going to be coming in around 433.25, top of the gap, 433.75. My apologies in here. We're sort of splitting hairs. Again, with this volatile range, this is now a 10-point y-axis. So you get the gist. This is it. And it's also the top end of a prior gap. Before we move forward, I just do want to show that as well off here to our left. So that would be a downside target. It's a thin structure target. And also, this is the daily 200 SMA. We weren't quite there yet in the S&P 500, but the NASDAQ, these things are certainly more so a consideration. As we were evaluating trend, let's get back to basics. Lower highs, lower highs, lower highs. We were talking about a lower high in here, upper edge of the weekly expected move. The structure that makes more sense to me is 467. If there's any counter trend rally, this is your sort of daily lower high zone in here. The most obvious would just be a gap fill reversal from Thursday's low of day. That's at 456 is the gap close, Friday's high, 453.75. Consolidation underneath this balance right here is bearish, obviously. And as we look left over here, it's not really, I wouldn't call it thin structure because there's a little bit of congestion in here, but it's not really like the market produced a ton of structure there. It was just sort of a very slow grind in the upward direction. Your big target is just the top of that gap. This, if you recall, was the higher low double bottom neckline. So that, once again, is at 433. We're going to round down there to 25, 433.25. 50, 25, what is it? I've got to zoom in here. I've got to make sure we're getting you the right level and not just sort of like fudging it for the sake of fudging it. What's the neckline level I want? It's 433.50, smack in the middle of what I was getting at. So there you have it. Always split the difference. Probably not the most sound advice, but in this case, it works out. That's what we've got on the QQQ daily. As we take a look at, we can take a look at the alternate drawing set. I mean, just not even close to being a backtest of the trend channel. We could throw on the daily 20 SMA as well and just clear rejection lower high on that Thursday session. Again, and on the hourly, we'll talk about what should have happened if the bulls were going to come out and play. If this was going to be the weekly higher low that stuck and it was like all rainbows and butterflies, once again on Thursday, this should have been a higher low offering for the Brigade bolt over the top end of the range. And then we should have gone up and closed that gap, or at least attempted to close that gap. It obviously did not take place, and we're continuing to acknowledge that this sell-side pressure is a change in tone. So on the hourly time frame chart, what's our brief pathing? We were pretty much squared away. A lot of overlap here with the S&P. Any consolidation down here, this is your downside to the top of the gap. Again, 50, 433.50 is that level. When we come into the gap, I would be thinking about the opportunity for a counter trend move out of it because it is the daily 200 SMA, and we've not tested that daily 200 in a very long time. Usually the first test is the best test. If there is going to be a rally to the upside, I would look for gap fill reversal off of Thursday's low and try to short here for a lower high. If there's no indication, so keep in mind, folks, we're looking for, it's not just a blind short, but we're looking for some sort of double top. We're looking for some sort of head and shoulders up here. We're looking for an hourly inverted hammer, correct? Short underneath the trigger point of either of those, any of those patterns really, back down to the equal low, flush from there. If the market tries to get acceptance over that 456 mark, I would be open-minded to a counter trend trade long over the right side of the V or on the higher low here over 459.50 to get into this level right here at 467, and then once again changing the mindset. This is really the most important part, right? And I'm sort of speaking more so to myself. This is my verbal reminder to myself, reinforcing the ideas, the concepts. It's been a dip buyer's market. I need to change, like literally turn the knobs in my brain and start thinking more and more and more about lower highs. It worked great over on NVIDIA. If you checked out our X post, our tweet, if you will, that was my own mental reminder, putting it out into the world that over on NVIDIA, just to quickly go out here, right? As the market was coming into this level, I was thinking, no, Matt. Like, although, yes, this was a huge bearish day and you've retraced all of it, you can't be bullish if you're still underneath this neckline, and that's what we have to now start doing in the indexes themselves. It's been that way, and you can see this here out of the QQQ, but it's been that way in the NASDAQ. It has not necessarily been this way in the S&P 500. Really, Thursday and Friday were massive game changers out of the S&P 500. Anyways, to finish off the NASDAQ, because we are sort of rambling a little bit in today's episode, if you enjoy the ramblings and thought processes, let me know in the comments section. Sometimes I'm overly critical of myself, trying to be as efficient as possible. I also want to respect your time too. So anyways, this lower high rejection and this overtime will be there at 467. Smaller time frame traders, your focus is on this gap fill reversal and this possible lower high. Any consolidation below, we covered in detail the downside. We can quickly check in on the fibs just to be congruent, coming in from the top end to the downside. 38.2 rejection is that 467. Picture perfect, lower high, the trend continues. 61.8, yeah, I mean, there's a lot of work before this even starts to suggest remotely anything close to a 100% retracement. No chance that a reversal is top of mind earlier in the week. This would require some further structure building out. Maybe there's something like this in the future. Way too speculative as of right now, and all of the data and evidence that I can see would suggest that is lower probabilities in terms of an actual outcome. Let's jump on over to the market internal specific to the NASDAQ side of the market. What do we see here? Of course, huge volume outflows on both sessions, Thursday and Friday. One thing I didn't really show you over in the NYSE side of things is if we do this, we have the hidden histogram here, the breadth continued to build bearish. So the ratio of volume flowing out of down stocks versus up stocks, right, was increasing. It was getting worse as the week wore on. That was a bit of a tongue twister. You get my point. So not even close. Like, you can't look at this market and say, no, it's a huge dip buying opportunity. Something has changed here, right? And of course we know it's the labor report. It's the fears of recession. It's growth potentially slowing down. It's, oh my goodness, if the Fed cuts rates, is inflation going to come back? Is all that work for nothing? And we're going to talk about the fundamentals too. Advanced decline line, even worse on Thursday for the NASDAQ, awful on Friday. I don't think I've seen a read this bad in a while. What would this tell me? Just like we talked about in the S&P with the, if you remember, the index score was technically moving higher into the afternoon. Because this was so, quote, oversold, it wouldn't be unreasonable for a counter trend to move higher to close the gap and then set the lower high. So be mindful of this really, really depressed read on the advanced decline line in the NASDAQ. Cumulative tick on both days, certainly in the downward direction, well beneath negative 5,000 on both instances. If we check in on the nasty NASDAQ futures, via the lens of the NQ and using market profile, all the same ideas that we just described over in the ES. We are completely underneath this. Value areas here on the Thursday session. Point of control migrates to where I thought it should have been on the S&P 500. You do have a little bit more of a excess low here on that Thursday session, but the gap, of course, is still there. So still all of these things are top of mind. A period single print's a little bit more clear versus there was some overlap with B in the S&P. So over this, which is actually a mechanical level, this is maybe worth carrying forward. Over this level at 18,620, over 18,620, I think that this could kick off the counter trend, not necessarily waiting for a break into the gap overhead from the NASDAQ. To give you the level over here in the, we want the QQQ cash, that's going to have to be over 449.50. What I'll do is I'll just drop this in as a dimmed out line. And in the spirit of sort of working on the charts actively with you guys in today's episode, we'll just do it together. There we have it. All right, 449.50. Over that is sort of your Stevie Wonder to close the gap overhead, setting a lower high in this zone. Do not lose sight of the mental switch that we've made and verbalized here in today's episode. All right, that's the NASDAQ. You know, it's the final one. It's the rut check. Let's take a look at the IWM and small caps. Going on out to a monthly time frame chart. Let's throw on the clean drawing set. And on this one, we actually want to back out to, I guess, 10 years. Is that fine? I just wanted to see some more context to give you the perspective of where this set of lows was, not just like, oh, there was a prior high there. So generally speaking, the breakout on the monthly time frame chart still has the offering to continue. Now, obviously, this huge reversal is not comfortable. I would not be bullish here on the IWM in the short term until we actually test the monthly top end of the range, which is closer to 200, 199. We talked about that zone for a very long time. But notice, and we've made this argument in previous monthly recap videos, monthly higher lows need to start somewhere, and we are technically pulling back from right here, right now, the monthly higher high, right? Not the all-time high like the S&P and the NASDAQ, but this is the highest high in the reversal trend sequence out of this balance range down below. So as long as this can hold on the monthly chart here, I would still be somewhat open-minded to big improvements for a higher low and the possibility for some attempt back here towards the highs. Now, of course, if the big, deep, dirty R word comes around, which is, of course, recession, then that's not going to be feasible, and you will see some sort of drop into the balance and possibly a look above and fail, in which case the target would be the bottom end of the balance here. We're not there yet, and trying to keep an open mind at the technical level of 200, but with all of the fundamental data and some of even the technical data we're about to walk through, it doesn't look all that convincing yet. So take that for what you will. If we come in here with the fibs from here up to here, your 38.2 on this move is not even the top end of the balance range. So really 200 is the main monthly focus. Let's drop it on down to a weekly. See what else we can learn. So obviously huge bearish engulfer, worse than what we saw in the S&P and the NASDAQ, I would argue. And, you know, all things considered, the top end of the balance range has been violated technically. So it's a very, 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 very tough chart to try to navigate because you don't want to be trying to short it dead on the lows of this overall move, but at the same time, the pullback is not looking like it's offering exactly what we want. To me, the chart is really suggesting that you need some better resolution to the top end of this range here. Yes, last week's close was nasty. Yes, we have the fundamental data to back sort of the idea that small caps are not going to benefit and boom here. If you take a look at the KRE, this huge reversal out of the KRE, it's pulling back from a higher high, so don't get me wrong, that's okay, but it's got to hold. If this drops back underneath, the KRE is sort of like an insight proxy to the small caps. If we're back below 53 on the KRE, I would tend to think that small caps in the IWM are just game over, back to 200 at minimum, right? So at least here, if not further. And that's going to be your smaller regional banks, right? And we know that obviously they're very interest rate sensitive, so rates falling off of a cliff, but KRE also moving lower, you might be scratching your head and saying, I thought lower rates were going to be of benefit. Well, not currently in this environment where technically what's happening, right, is the longer term bonds are moving higher, driving longer run rates, shorter run rates in the downward direction. And that's sucking money out of markets. People want safety, not necessarily, you know, they're not going into regional banks looking to finance deals and have things in the small cap speculative side of the market work out, right? So it might be, I know for a long time, right, the mentality is, hey, lower rates are going to benefit small caps. Well, under these circumstances, because of the way we're seeing bonds react with, you know, in response to very specific fundamental information, I would not argue it's that typical relationship of rates moving lower are also going to benefit what you have at a small cap. So I'd like to be optimistic. Again, I've got a long-term portfolio. I'd prefer to be optimistic and like to see this, you know, find support over 209. But just looking at the charts and the data set we have in front of us, needs a little bit more resolution here on the higher time frame. We do want to check in on this because I think that this helps us remain, I don't want to say overly confident, but it gives us still an open mind for a cluster set of higher lows on the monthly to still form after this higher high. So the fact that this could potentially hold is still somewhat optimistic. If you come in from the bottom up to the top of this move, the 38.2 has not been violated. Unfortunately, it's a very, you know, optimistic take because if you come in from the bottom, the origin of the breakout rally, really, you're already underneath the 61.8. And this is being optimistic, taking this low. If you want to take the true origin of the, you know, move to the upside, it's this, and that's even further under the 61.8. So just trying to vocalize some of the concerns I have out of small caps here. And the bottom line, the takeaway is just that as we're thinking about the broadening nature, quote, of the market rally and how that might help the S&P 500, the thesis might need to change and evolve as this pullback takes place. It's not looking like it's the same, oh my goodness, look at this is going to be helpful for the S&P. And it's not just like, oh, the market's up, the market's down. Of course, markets go up and down. That's, you know, it's understanding why that's taking place and the implications for the S&P 500. So the fact that this move is happening on the data from the jobs market, that's the concern, right? Also, that KRE, right? Rates moving lower and regionals moving lower, not really the combination that you're looking for. So we spent a little time here on the higher time frames because I think that story is worth understanding. But let's drop it down now to the daily. Let's reset some charts here. Let's level set. Daily time frame chart. What's the actionable takeaway this week, Matt? So we broke down from this overhead supply. This, as a more nuanced balance towards like the earlier stages of this week, led to a failed breakout over 226. So I would argue the next major, this is what happens when, the candle is so stealthy and just sitting down here already. I'm thinking, oh yeah, just break down through this neckline. We're already there. Okay. Goodness, that's wild. So we find ourselves underneath the 209, which we were just looking at on the weekly time frame chart, on increased volume with an indecisive doji, no oversold reaction, trying to close a majority of the gap. I would say a little bit of volatility there, but nothing major. It's not like buyers really stepped up on the huge retest to the top end of the balance range. So the daily chart does not look constructive for dip buyers here. I would argue that this is a threat for a lower high, and I would say that your two scenarios that you have to watch for this week in the IWM. If we rally out of the gates, go gap fill reversal, do you hold or do you not hold 209.75? If you hold, fine, maybe somewhat optimistic in the back pocket for the S&P. If you don't hold and you come through, it's game over. You've got to be more bearish in the S&P, no broadening nature of the market rally, big concerns about the R word. If the market doesn't get here in the first place, if it's just consolidating down here anyways, below 210, 209.75, R word instantly comes to mind, recession, right? So markets are going to start pricing that in a little bit more aggressively here, and I think that small caps can act as a perhaps more clear signal for that versus the S&Ps, which have been trending a little bit more clearly versus your small caps, which tried to develop a new trend, but if this trend fails, again, it's shouting at you, hey, pay attention, this failed, right? So that's what we have out of smalls on the daily. Let's go down to the hourly chart. Not much to really lean into here. Failed breakout, huge move to the downside, flush the neckline gap, all the same things that you would typically think about. So if you're going to get the gap close, Brigade bolt in the gap structure is over 211.30, closes down, or up, I should say, at 214.80, lower high here, brings you back down to that 209 test. This is where that question takes place. If you're just consolidating down here, ugly gap close under 207, targets 203.60. What else can we say about small caps? So we didn't mention the upper and lower edge of the weekly expected move. However, this is a lower high, and this, of course, is a lower low. It would sort of imply that the trend will be down. If we bring out the Fibonacci's from the top end of this move to the bottom, if we could get a click, there we go. 38.2, perfectly aligned with the gap fill reversal. This could be considered some sort of very sloppy double top, gap fill reversal, neckline rejection. That's where the bears step in, right? So this is all making sense from a technical perspective. If we bring out the intraday anchored view apps, what do we see here? Again, just barreling down over time. These things will start to align with that 214.80 key area of resistance on the small caps. Let's quickly take a look through the Russell internals. It's not going to be much of a shock over here. Bearish, obviously, huge bearish. Not as bad on the cumulative build here on the Friday session, which we could kind of see anyhow on the hourly chart. We were more so sideways instead of continuing the trend to the downside. So counter trend rally, again, might be reasonable out of these things, but keep in mind the mental switch we've been talking about all video today is just even if we rally, you've got to be thinking about setting lower highs, not huge reversals back in the upward direction. So those are small caps. We could take a look at the Russell futures on the market profile to see if we can learn anything new, but as you guys probably can already tell, there's not much to really get on there. The value area point of control certainly lower on Thursday. Here's your very normal curve distribution on Friday. So counter trend move based on this being a normal day, sort of reasonable at this point. Repair the poor low, gap fill reversal. That would be here at 2180. 2180 in your Russell futures, which again is the equivalent of 214.80 on your IWM cash. Let's reset this back to the daily time frame chart. We'll keep this show rolling right along. One take today, it seems like. What do we see out of the sector performance on the week? Horrendous risk off posture. Risk off here. The reason I would say that is that our leader is the TLT, obviously not an S&P sector, but it far outperformed the S&P, huge by substantial margin. Utilities, the most bond-like sector, also up there. And then you can see real estate and consumer staples. So like nothing risk on is green here. I mean, XLC maybe. XLV is also green on the week, but this is D for defensive. So defensive sectors are up on the week as the broad market is pulling back aggressively. The risk on sectors, semiconductors, not directly a sector, but you get the point, down 9.9%. That's one of the worst weeks we've seen in a very long time. If you recall, there was a week we were down over 10%, but this is right on par with that. I mean, this is huge. XLK down 6.09%. Discretionary taking a beating. Energy's even taking a beating. So if we're thinking about global demand for oil, this really boils back down to that R word. it's not looking good from a posture perspective. So in the intro, when I say, hey, risk-off data points are starting to emerge, this is just the tip of the iceberg. Let's check in on these charts. TLT absolutely ramping in the upward direction. Even at times on the Friday session, the market pricing in a double cut in the September timeframe. We'll talk about the Fed tracker tool in just a moment. So I think that this is important to understand. So as the TLT moves in the upward direction, obviously you're getting downward pressure on interest rates, right? That's the mechanic. They're inverse to one another. But where is this money coming from? Where's the money coming from to buy the TLT? Well, look at what's being sold. It's semiconductors and it's tech. So the trade right now is seek safety in bonds and abandon, I shouldn't even say abandon, but rather take profits, book huge profits in the technology sector as we start to come into this first rate cut. That's like as clear as day, the relationship between these two things into the end of last week, especially with the data drop on Friday. That is a risk-off flight to safety style market. I think that's worth talking about. XLU is obviously like a similar proxy for bonds, breaking out. Look at how it performed on the week, right? So same concept there. That's risk-off. Real estate, as rates come down, typically land hard assets seen as defensive, so not totally out of line there. I don't know what your local markets are looking like, but there's still pretty low supply on these markets, at least where I'm at. If we look at the XLP, this is D for defensive. It broke out on Friday. That's not what should take place, right? So, all of these risk-off indications are really, really crystal clear as we start diving through the sectors, and it's so important how just 2 days can change the tone of the market. Now, I want to pair this with okay, should we be doom and gloom? That'll be the remaining question to sort of think about as we travel through the risk on sectors and we get to some of those charts. Is it doom and gloom, or is it the emergent stages of risk off? So XLC has the opportunity for a double top. Are we below the neckline yet is kind of a key question to ask here. The answer is no. So it doesn't look good. The fact that we couldn't hold a higher low cleanly off of this, the fact that we gapped up and crapped so aggressively with Meta there on Thursday is really not a great indication. But is it possible that you do something that looks like this? Maybe, perhaps. I'm not going to say it looks great. The candle structure would not suggest that, but it's still on the table. If we look at the healthcare sector, what do we have out of this? I mean, huge break to the upside. This, of course, is the third heaviest weight sector by market cap. It's also D for defensive, so that supports the risk-off rotation. Here we go, semiconductors. Is it doom and gloom? What did we talk about? We had talked about how this right here was your line in the sand. We already knew that the daily chart, dropped its possible area for an equal low, and we were now thinking about lower high threats. However, there was an offering in this zone of a possible weekly higher low. That has completely failed. You are on a weekly downtrend. This actually does look a little bit more so like doom and gloom. So, semiconductors, awful. If we look at the technology sector, same concept. You dropped your neckline of what could be considered head and shoulders. We were mindful of the lower high threat here. And where was the possible higher low? On the weekly, right? This was our line in the sand, 212. Underneath, huge gap down on Friday. So these lower highs, these threats, they're starting to look like, all right, no longer can we qualify this as a daily uptrend, a weekly uptrend. Those things are gone. If we take a look at the XLY, ideally, you would have seen some sort of higher low at the 50 SMA, this recapture on Wednesday, then yielding a higher low above for this. Obviously not the case. Right back down to an equal low. So in my view, this actually is a huge look above and fail with the Brigade bolt underneath. The target should be the bottom end of the range, 170. Wouldn't be shocked to see this move lower, even if it's like a gap fill reversal and then lower. This is just a huge lower high opportunity. So these trends have changed. The doom and gloom does start to appear to be coming into these markets based on the magnitude of these gaps and the loss of really just key structures. Energy, right back down to the equal lows. Again, thinking about travel demand, just generally production, economic output, usually that goes hand in hand with a healthy sort of energy market, right? And this is not the case. Huge reversal after what started to become this offering in the upward direction, right back down to the equal low. So that, again, recession word really starts to come to mind. Now, what did we see on the monthly S&P 500 chart? Are we there yet? Probably not. It's nice to be mindful of these things, but the very beginning stages are starting to emerge, right? I want to be very clear about your time frame of analysis, your time frame of execution. These things need to be considered, all right? Financials, what do we see out of this one? Huge break through the neckline. However, at a line in the sand needs to hold 41.75. If you are below this, I would be worried and be thinking about the rotation into 40.45, and JP Morgan as a chart in just a second, we'll take a look at that, it's in the core list of companies, is not helping the case here whatsoever. Huge breakdown in JP Morgan. So, I would tend to think that this lower high opportunity here is a huge threat this week. So on a counter trend move out of financials, do we set a lower high and does it not look great? That would be like, okay, sustaining bearish pressure in the S&P. It's not just isolated to the technology sector. Even financials, the second heaviest weight sector by market cap, feeling some pain underneath that neckline, setting a lower high, failing the weekly high or low. This would have to be your weekly high or low. 41.75, huge watch here out of financials early on this week. Industrials, midpoint of the balance range. I would argue for look above and fail. Target should be the bottom. If we make a new pivot low, running for the hills. Let's take a look at the XLB, midpoint of its balance range. Really lightweight sector. Ironically, neutral, doesn't really tell us much about the market. Let's get the show on the road. What do we see out of our sector ratios? Huge down, well, I shouldn't say huge, but just a more meaningful fall off out of the XLK ratio. Financials are trying to hold on to this reversal, but as we just saw on the structural chart, still a threat for some more pain. Healthcare is defensive, so this breaking out really is not a savior, and discretionary looks pretty pitiful here as well. The risk-off sectors are perking up more meaningfully, especially on Thursday and Friday. Over the 50 SMAs. This is a risk-off sort of look that is brewing in these markets, especially with your larger red flag. I know it's white, but up here in the XLK. If you're not familiar with this dashboard, by the way, check out the ratio tutorial in the top right-hand corner. Let's drop this over to our specialized ratios. So this is government-backed short-term bonds versus the tech sector. You can see there's a preference to sell tech and buy short-term bonds. As we know, rates are coming down, right? What does that mean? That means people are buying the bonds. So they're getting in there. Utilities as a proxy, same thing. Huge move to the downside. Most important note here is that on the Friday session, we actually made a new pivot low underneath this previous set. That is risk off. Apples to apples. This is consumer discretionary versus the tech, consumer discretionary versus staples, right back down to the bottom end of the range. Again, look at the damage that 2 days worth of trade can do. So really acknowledging this sort of change in tone. I think I've been very clear about that in today's episode. I don't want to be overly doom and gloom. Again, early on in the week, I do think a counter trend move is possible to close some of those gaps, but the sentiment here is clearly changed. So SMH, this is semiconductors versus healthcare. Even that is moving down, into these equal lows from back here instead of trying to find some sort of higher low above. You can see this interaction, previous support acting as resistance now. It's a bearish flip. Down below, we've been talking about this recently. I'm not going to claim credit as an original idea. There are a lot of people talking about it over on X. Michael Gayad has been talking about it for years now, and his time has finally come. But the yen carry trade is unwinding. And if you're not familiar with this trade, you can do your own research on it. And if you want to look at something that's maybe a little bit more obvious, you could go to something like the / what do we have? 6, is it Y for yen? Nope. Maybe is it J for Japanese yen? Yes, it is. So if we look at the yen futures, huge move higher means that the cost to borrow yen is no longer basically zero. So you can't go out, borrow yen for nothing, go back, buy American dollars, and use that as leverage basically to buy equities or invest in any sort of investment vehicle, right? So the yen trade unwinding here, look at how aggressive this move has been, is also a reason why you're seeing money coming out of the more speculative bets. Think about your NVIDIAs. Just generally think about the NASDAQ, right? The levered bet that's there is becoming unwound to some degree based on that yen trade. As we take a look at some additional indications, we could take a look at the QQQ versus the IWM. Hanging on to hope, but ideally this would have found a higher low above this level. This threat here would tend to lead to more pain in the S&P 500, so watching out for that one. Let's check in on the dollar. Not a shocker to see it lower, especially on that Friday report here. In theory, you would think it's upward pressure, right? Classically, a weaker dollar is going to boost equity valuations, right? Not the case. So again, noting the relationship that both of these are down, this is where we have to start thinking about, again, what trade is unfolding here? Is our equities lying or is the dollar lying? And at this point, I would tend to think that the relationship is just not standing. I don't think either one's particularly lying, but again, sell technology, sell everything that you made a boatload of money on, flight to safety right on over here in the bonds, and dollar is also weak with that. Again, it shouldn't be a shock here. As we take a look at gold, flight to safety is remaining relatively elevated up and over this breakout point. So that's, not looking great from a risk on perspective. As we look at interest rates on the TNX falling off of a cliff, we've been pretty clear about this so far, that we're no longer using the mental framework of, hey, lower rates should help out the tech sector. Instead, no, it's sell the tech sector, and as rates move down, your bond valuation should go up, right? So yeah, your yield's not going to be as high, but the value of those bonds should technically increase, right? So that is your TNX relationship as we look at the inverted ZT. Of course, no surprise here to see it falling off of a cliff. And now we've got to have our conversation about the fundamental side of the market. Here's the Fed tracker tool. What do we see? At some point on the Friday session, I'll show you this in just a moment. Actually, with an hour to go into the close, I specifically remember taking the screenshot at 3 p.m. We had a double cut. I'll show you that in a second. But currently pricing in 78% odds of a cut. I shouldn't say cut, a single cut in September, 100% odds of a cut in general, 22% odds of a double cut. And of course, the market's fearing that right now. They're saying, hey, the employment situation doesn't look great right now. Is it possible we fall into a recession? The Fed's here to bail us out. That's why these odds are dramatically increasing. And notice it's straight through. If you recall, like not even 2-3 months ago, we had something like 1-2 cuts and then a pause, right? And that's just completely out the window. Market participants, as priced in by the bond market, are clearly showing some sort of fear about a recession around the corner. It's like the soft landing has sort of gone out the window. So, you know, everybody who's been saying a recession is going to happen, it's inevitable, they'll have their moment, but how long were they wrong for before they're now, like, I think if you accurately assess the data, when it flips like this, that's when you want to change your tone. Instead of saying like, nope, inverted yield curve, it's got to be bearish, it's got to be a crash, it's got to be a recession, being short the entire way up. So wait for the turn. That's the beauty about technical analysis, is that you can see when the weekly trend reverses. Anyways, here's that double cut I was just referencing. If I open this image, we actually had 72.5% odds of a double cut at the heat of the moment at 3 p.m. on Friday's session. That is, oh my goodness, something's broken. Fed needs to come to the rescue. Another double cut, higher odds on that November reading. That Friday was a the market was scared. You could feel it in the air, and you can see it in the data here on that Friday session. So what caused all of this? Of course, it was the labor report, but what specifically in the labor report, Matt? Well, hourly earnings, no indication here of a wage price spiral, and that's actually a good thing. If we scroll up, you'll notice earlier on in the week as well, the ECI was also underneath the expectation. So if you're trying to balance what's going on between inflation and the labor market, I would actually argue that this is good for the inflation side of things. We're not seeing wage price spiral, which is inflationary, which is the double-edged sword, right? But this is the big deal. Non-farm employment comes in at 114,000 versus 176,000 on the expectation. Previous is revised from over 200,000 down to 179,000. Now, there's classically always revisions to the labor information here, the NFP, but this is just such a substantial miss, as is the actual unemployment rate. I was expecting maybe it might round to a 4.2 because we get something like a 4.1516, but this is just a straight up miss. Like not even a rounding error. It's an absolute miss, and the market's pricing in, oh my goodness, what about the opportunity for a recession? So as we dive into the data, and a huge shout out to Michael McDonough over at Bloomberg. You can follow him on Twitter. This is where I usually get most of my Bloomberg information from. Look at what's going on here. As we actually interpret the data, what we want to focus on are these numbers back here, the comparison. Where are the major losses picking up in the market, and you can in the labor market? You can see that reentrants were pretty big. You can see down here that permanent job losers had a slight uptick, but the largest is actually right here on temporary layoff. So there's an argument going around right now, and I want to be as transparent as possible, that there's some commentary that the weather actually was an impact here on this month's unemployment rate. And I don't know necessarily that I'm convinced that's the case. There was, some citations of Beryl, the hurricane that, sort of slammed Texas, being a component of that. But I would tend to think, and here's where the logic comes in, although, yes, some people who work office jobs maybe couldn't commute and there's some temporary layoffs and whatnot, wouldn't it also create plenty of temporary jobs that would then, be related to a cleanup effort? So I'm not sold on the logic there. But anyways, this is, I think, important to point out that was these two segments right here, really permanent job losers and temporary layoff, were the ones that saw upticks. And the permanent job losers are obviously the more important one. Generally, the trend here is up out of the unemployment rate. And as you take a look at the actual NFP, the jobs that were added to the economy, this was looking like stabilization. Jerome Powell on Wednesday cited that the labor market was coming into a better balance. This is better balance. He also said very explicitly he did not want to see a continued deterioration in the labor market. He thought that the balance that was achieved was appropriate. And if you remember the strike-through version of the statement, they were acknowledging the better balance of risks between the maximum employment mandate and stable prices. Well, this now just looks nothing more like then just a downtrend. Look at where the jobs are added. It's all seasonal, right? So education, obviously, as we start gearing up for school in September. Leisure and hospitality, they obviously added a little bit here. Construction added a bit here. Government added a bit here. But what typically are going to be your higher paying jobs? And say what you will about it. Oh, it's unfair. It's this, that's, it's whatever. It's just the data. Information jobs as well as financial activities saw losses. And that typically are, that cohort of not only worker, but just think about them as a spender, right? They have more money to spend. They have more money to juice back into the economy. So the fact that you're seeing a contraction there doesn't really spell like rainbows and butterflies. Oh my goodness, the market's safe and good to go. The labor market's going to come springing back with this huge thing. No, you're seeing the seasonal ads here and here, as well as construction, but you're seeing, more importantly, heavy hitters losing jobs. And obviously that's reflected in the unemployment rate as well that we were just exploring. I do want to show you some additional indications over here. There's this thing called the SOM rule, which measures the rate of change of the unemployment rate relative to the past 12 months of data. So up here, and this is over on Thinkorswim, we have this, I'll try to make this study available as we also make the index score available. But the SOM rule triggers when it's over the 50% mark, and on this month's read, we're over 50%. One of the things that I had been watching prior was the 12-month moving average versus the 24-month. So you could just think of annual versus 2-year rolling average unemployment rate. When that crosses, you tend to sort of get this out of control spiral of unemployment, right? It's very hard to put the genie back in the bottle once unemployment starts to unwind. So, does it mean that the recession is coming? This data point would certainly suggest, yeah, it's not looking great. An additional thing that we can look at, we oftentimes don't talk about all of this stuff on the channel, but this is included in the chart package, by the way, if you picked it up from our website. But when the market, this is the 10 and 2-year curve, as people note it, right? 10-2. So when the curve starts to go back positive, when it's called re-steepening, right? That's when your pain steps in. Re-steepening, pain steps in. Look at how close we are to the zero line. If we pop up and through this, is it possible that we start to see the pain set in the market? Do we start to get that recession indication? Again, I'm not trying to be overly bearish. I want you to remember, this is actually a monthly chart down below, which is quite convenient. The monthly trend is still up. Recall that on all of the indications, and we've talked about this so many times, the monthly trend has to flip down before you're going to get a watershed moment like 2008. Here's the dot-com crisis. The monthly trend flips to down before you get your two really painful components in the downward direction. So don't feel like you have to go out there tomorrow, sell everything, go short the market, but we're just starting to think more so, is this possibly a topping formation as we get closer to the Fed adjusting monetary policy in response to a deteriorating labor market? That's sort of where my head's at on the higher time frames. We're on edge, we're prepared, but we're probably not taking action, or at least I'll speak for myself. I'm not taking action yet. In the longer terms, that would be like, oh my goodness, let's sell and start to get way more defensive, right? I would say so far, it's more of like your hedge funds, positional trades, pension funds who need to respond quickly. Again, I'll speak for myself. I've got plenty of time before I've got to pull out my retirement fund. So I probably have a totally different outlook than any of you might. Anyways, here's the earnings calendar, because this is going to continue to drive the market. Berkshire Hathaway, heaviest weight component of the XLF, Monday before the open. Palantir, get your popcorn out. We remember that Starbucks technically moves more market cap than them. Maybe not these days, but still. Supermicro will be a top watch, and this is actually a trade idea that we're about to dive into towards the end of today's episode. And then your larger deals, I would watch out for Shopify. What do they have to say about e-commerce right now? Is that slowing down as we're also starting to hear sounds about, hey, labor market's not looking great? Is growth and sort of revenue also coming down from someone like a Shopify? That to me would be insightful. And then Eli Lilly is going to be huge for your healthcare sector. That would be a top watch for me. You could add in some honorable mentions like Datadog. Unity used to be a good trader back in the sickness era, but not so much anymore. The Trade Desk is decent trader. Rivian, okay. Uber, okay. Some of these names in here. Caterpillar could be decent as a watch for industrials to figure out what's going on in that sector of the market for sure. So that's my sort of earnings outlook going forward, but let's reflect a little bit on what happened or what's been happening over the last little bit here. These are revisions to Q3 earnings this next cycle. So not what we're going through right now, but for the next cycle, they've been consistently being revised in the downward direction. The market is not pricing in. And again, think about what our old conversation used to be about before the labor market deteriorated more substantially. It used to be, hey, if rates come down, I would expect earnings forecasts to go up because companies will be able to squeak out more margin, right? The fact that rates are coming down and earnings forecasts are also mirroring that, coming down, does not look good. And you could say, Matt, we should have seen this coming from like so long ago. Wouldn't you rather pivot now as the technical charts are starting to change trend instead of trying to call the top every single time on the way up? That's my take at least. But anyways, I did think that this was important to bring up here in the outlook today, as well as you can see where specifically at the sector level that change is taking place. Utilities are actually being revised up. That makes sense. Very bond-like, right? IT, information technology, I would expect this to actually move lower in the overall lineup. But as we look down here, the energy sector, this falls back to like global demand for oil basically. And I'm thinking like, growth does not look good if energy is being revised down so much to something like negative 6.6. Wow, that's having a huge impact on sort of what's going on over here, right? So anyways, that's your fundamental take. Let's get back on over to the platform in our one take episode today and jump on into some specialized indications. TLT ratio to the S&P taken off like a rocket ship here. I would say that this time is different from what we had in this uptick back over here, simply noting this never took out the previous swing highs, whereas this did take out the previous swing highs. The reason I call them swing highs is because you have this and then you had this. So not only did you break out, right, but you also took this out. So that move to the upside once again reinforces the idea of the flight to safety with bonds outperforming here, just a different way of visualizing it, obviously. As we look at bonds in relationship to themselves, again, changing the way that we think about this. In a classic sense, you would think, oh, look, these are falling over. That means that risk appetite is for a longer duration. No, it's just that we know that yields are going down in the short term, and that's why these things are not looking as preferential. If we take a look at the credit spreads, this aligns perfectly with the yen carry trade. Yen carry trade would sort of imply credit risk as the leverage comes out of the market from that particular trade, and you're seeing that here, right? Longer run bonds are more attractive than what you're getting out of, longer run government-backed bonds are more attractive than corporate grade bonds, right? You're seeing the risk in the market here. So as these credit spreads expand, that's downward pressure. This is a classic indication. We sort of caught on to this a little earlier as this medium term was more divergent from what was still somewhat looking weak out of the shorter term, HYG. So this one has actually been playing nicely and starting to see them sync up in the upward direction. Also with that yen absolutely ripping to the upside in isolation and obviously related to the dollar falling apart to the downside. Let's jump into the high yield junk by itself. This is back lower, so this positive divergence is no longer playing out as aggressively. Notice from here to here you have a lower low. Obviously you have a way lower low in the S&P, but it's back in sync. The positive divergence never caught this sort of here. Remember that this was one of the only data points that was like, hey, maybe there's sort of this idea to happen in the S&P because of this bullish divergence. Well, that's been wiped away. You can no longer really look at this as a supporting factor for the buyers. Let's take a look at Bitcoin. It's really stable in the range. I wouldn't say there's much to talk about on digital gold right now. New highs versus lows. A little impressed here. Got to give credit where credit is due. Technically over the zero line, not flipping to negative, even with all the pain that we saw in last week's worth of trade. I'm not quite convinced that it's going to stay over the zero line here. Simply noting what we talked about at the exchange level in the internals for the NYSE. If we take a look at the SPX A200R, this is not rolled over more aggressively. So I think that this one in particular, because it measures the 200 SMA, right, is more aligned with our monthly analysis, just to say like, we're pulling back. We're starting to see the beginning signs of volatility, but that monthly trend has not changed yet. This reinforces taking a little bit more of a patient approach if you're a higher time frame investor, or at least just not a short-term trader, right? This has nothing to do with short-term, trades, ups and downs. Let's take a look at the 50 SMA, basically in the S&P 500. So majority of companies still over, but notice the lower high happening here and lower low into the Friday session. So I'd just be watching the 50% mark. If we can hold it, I would argue it's still trying to be constructive, and perhaps a better visual is just your RSP. So yes, you got a ton of pain in the weighted S&P, but notice that this hammer is actually supporting. I would say that if you're looking for a diamond in the rough, if you're looking for one, like if you're the perma bull, which I know in the comment section I get called the perma bull of YouTube all the time, I would latch on to this data point and I would shout it from the rooftops. I would say, look at this RSP holding the neckline. It didn't break down. It didn't see follow through. I think it's going to be bullish, do this, and then break to the upside. Now, that's not my take for all the reasons that we've described so far today. In aggregate, all of the data points seem to point to a shift towards risk off and more seriously reevaluating the market, but the RSP is technically one diamond in the rough. As we look at the QQQE, just not even so this lower high is sort of the most important factor. If it was going to be more bullish, you should have poked through and tried to accept here as this was coming into support. That would have yielded a better outcome to the upside. Obviously, the lower high would speak to bears taking control. Nothing to report about in the Dow. And as we get into volatility, I mean, huge uptick over 2050. Typically, you're starting to talk about a climax top when you get towards this 30 read. However, if we take, and just to show you some history here, actually, let's go back to, I don't know, 10 years will do. Maybe actually it's a bit closer to 40, and that's why we have it mapped out, obviously. But, the sustainability of seeing prints up towards 40, over 30, generally short-lived. Like, you see these pain moments, and then the market comes back in. This, of course, is when we were in this big downtrend, 2022. It's off your screen currently, but this is not over, and my reasoning behind this is because the VIX, you got to look behind the curtain with the VIX these days, and the VVIX is well over 120, which is sort of its volatile breakout zone. 103 is the danger zone, 75 is the complacency zone. Over 120, there's no reason to believe that volatility is going to slow down. So if the VIX is going to come down, the VVIX firstly has to get under 103, and with this close on Friday, I'm not convinced. If you look at this also, so this is the futures spread, front versus back month, is in backwardation now under the zero line. This, I think, will allow volatility to persist. If you think about what this means, basically, right? The market's pricing in that in the present day, there is more risk than at some unknown point in the future. So why would you allocate capital right here, right now, if you could wait it out and potentially take a lower volatility approach at some point once the, quote, storm has passed? So the longer this remains below zero, I think that it's like a self-fulfilling prophecy in the sense that it's going to continue to keep money on the sidelines and not allow for a bottom to really come in. Eventually, it'll bottom at some point. I'm not saying it will never bottom, but as of right now, I don't think that this first initial spike of volatility is necessarily over. This is still in backwardation here, and the one-day VIX printed the highest print since its inception on Friday after that labor report. So that should tell you something. Let's take a look now at the core list of companies, and we will keep this show on the road. Let's take a look. So Microsoft is up first, and then I've got those 4 trade ideas for you, so stick with me on that. Core list of companies, then the 4. Microsoft, huge head and shoulders, right? You could make the argument that it's a very odd right shoulder here, or even this right here keeps you underneath that on the lower high attempt. So it's got to be bearish. I don't really see a reason to believe why Microsoft would suddenly be considered a bullish trade here. I would argue that the biggest loss was the failure to find any support here in the lower high that was actually set underneath early on in this trading week, even reinforced on the Thursday high of day session. The fact that we're below this leads me to believe that any consolidation here yields downside outcomes through an equal low breakdown here and here. That would be the clearance of 405.35, targets this low at 389.15. There is some choppy-ish structure from back there. If we take a look at the hourly chart, you might be able to see it. Yeah, there we go. So, I mean, you could maybe pull out something like a 395. I would tend to think it's more of a blip in the road, or a quick hurdle to get over versus a major reversal point. These lows are really, in my view, what the market will be aiming at. Let's come back over here though. So how does this trade unfold? I think that your Stevie Wonder possibility is there. Lower highs here, 416, 414.50. Treat it as a little bit of a zone. I think now is a good time. It would have been even better if I said it when we were looking at volatility VIX, but now is a good time to sort of recall that as your stop losses potentially get wider, so your stops get wider, if you're trying to take the same amount of risk per trade, dollars at risk, technically your stop loss should get smaller. Your position size. So the stop loss is going to get wider. I'm all over the place here. If you're trying to risk the same amount of dollars, let's go PS here, position size should be smaller. That's what I'm trying to get at. So if before the VIX really exploded, right, you were taking risk that was maybe, I don't know, let's just say arbitrarily 25 cents here in the Microsoft underlying. Well, now if your risk is $1, it's 4x. So your position size should reflect that. All right, so your targets are obviously going to compensate by being wider as well, but I think that's a really responsible approach to trading volatility or using a using a scalable metric for position size as volatility ebbs and flows. High volatility environments, probably smaller position sizes. Lower volatility environments, probably larger position sizes, so you can still aim for the same amount of dollars at risk. So wanted to put that out there as we're getting into the core list of companies. Up here, the idea would be for risk reward that looks something like this. Again, this is 1.5 points of risk in this box. You mean to tell me that you're going to use the same position size as normal? I'm not convinced. So, anyways, Stevie wanted to get there. Lower high that's set, equal low breakdown. We talked about downside targets. If it's going to be a reversal, I would have to see, at least an equal high to here, 425.75, and then a break maybe gets interesting. I'm not sold on the reversal here. I think there's too many data points we've seen so far today that would sort of suggest that the downtrends can remain intact a little while longer. Here's Apple, daily time frame chart. Everybody is shouting it from the rooftops. There's your head and shoulders. There's your neckline. Look at the nasty inverted hammer from Friday. Underneath these lows, equal lows are the target at 207.75, so that would be below 215. Here it is on the hourly time frame. Notice the multiple failures to really stay over this level here. Notably, Wednesday, nothing on the pullback right below. Thursday, oh look, yippee, earnings, they actually reported decent numbers, right? Well, on Friday, unfortunately, we closed right back down underneath. So to me, it's a lack of acceptance from the buyers to really break out of this range. It's looking like nothing more than just a sustained area of lower highs from here to here, equal lows, and then that breakdown once again underneath 215, ultimately targets 207.75. Next up, let's take a look at NVIDIA. NVIDIA, I think, offered just, put it on a silver platter, serve it up, beautiful lower high here. That trade is mostly played out. You've hit your equal low target. I think the name of the game here is to either watch for another lower high up against 111.50, and then now you have more of a descending triangle, something with equal lows. Whoa, too much zoom, apologies. You have something that does this and then back down to the lows, right? Now this starts to emerge as the pattern. Descending triangle, equal low breakdown, gives you your gap close to 96. There it is. Got that one implanted in my memory. 96 as that target is quite important because back on the daily time frame, this brings us back into the breakout point from over here. I would be open-minded to an opportunity for a monthly or just in general higher time frame attempt from buyers to try to buy the dip around that gap fill reversal from the previous earnings cycle. Earnings on this are much later in August. We don't have to worry about them just yet, but 96, huge watch out of NVIDIA. For now, though, in the more short term, I would tend to think this lower high scouting opportunity is top of mind here. I would only be bullish on NVIDIA if there was some sort of recapture that looks like this, in which case you have a double bottom 1 and 2 with Brigade bolt over the neckline at 118. So there's a lot of work to do if you're flipping bullish out of NVIDIA. It doesn't mean you can't trade counter trend, that's fine, but I would really be open-minded to those lower highs here. And even again at 118, honestly, this is really what's required if there's going to be a flip. Next up, GOOGL. Equal low flush. That's basically all we can say. Lower high here, descending triangle, the whole 9 yards that we were just talking about. It's very similar to NVIDIA. If we just back this off to a daily, you can see that instead of a neckline, you just have this consolidation, which broke out. So this lower high being set underneath is pretty, consequential for the shorts, meaning that this can break down through the gap structure. I'd be bearish here underneath 170, looking for a lower high opportunity, equal low breakdown. If it's going to turn into a double bottom, once again, just like NVIDIA, you've got to show me that Brigade bolt over the neckline, over this zone, 174.25. And even at that, we're really just trading for the gap framework here, 176.25 into 181.50. Next up, Amazon. This is a let the dust settle trade. I don't think there's anything obvious to do here as soon as the bell rings on Monday. You do have a long-legged hammer on Friday, which of course closed right at the 200 SMA on the daily. The issue I see with it is that unless you find a quick draw McGraw setup off the open, you've got the bottom end of this huge overhead supply, which can continue to weigh on price in the downward direction. I would tend to think that 172.85 here is still a threat. So I'd prefer to let the dust settle, let some more structure build out, and we'll take it in stride. Of course, the gap range is there if you're trying to structure something around that framework. It's 168.75, 180, 180. Next up, we've got the metaverse. Completely closed. The earnings gap did find a gap fill reversal. So somewhat open-minded to if that gap fill reversal can stick. I would be open-minded to a long if on Monday we can spot an intraday high or low over 493. My first thought on the gap up from Thursday was if we could get a pullback into 493 that offers a reversal here, then great, we'll take it back in the upward direction because on the daily time frame chart we would have remained over this level, which represented the range. Now, because of the way that the gap found such a prompt reversal off of the close there, I would almost be willing to entertain the idea of a possible higher low here and scalp it long. Again, not overstaying my welcome or anything like that, but trying a long here over that 493. It's just such an important daily inflection point and the response off of the gap close is so severe versus some of these other names, obviously not Amazon, but the broad market closing a little bit more weak there, I'd be willing to entertain this one. And obviously it gapped up on earnings versus Amazon, which gapped down, of course, right? Google gapped down. So that's sort of a watch here out of Meta. 493 would be that really important level. Next up, Tesla. Let's not skip around. There we go. Breaking down from the balance range, it's still a thin structure retracement, a little bit of a dance maybe at 201, but ultimately I'd be looking for 188.35 here on the daily time frame chart. This is nothing more than a high, lower high that is completely detached and a stair step in the downward direction from the overhead range. Lower range, equal low flush. So now it's either this and then this, or just straight up this is reasonable as well. I'd be thinking about that here out of Tesla early on in the week. When we get to 188.35, entertaining the opportunity for a reversal off of it, but more so for, yet again, another counter trend move. So if it's straight lower first, then it would be for something that looks like this over time. If it's this first, and then 188.35, I would not really, I would still look for a counter trend, but underneath whatever this equal low breakdown is. It could look like a consolidation here that moves a little lower and then this, right? And then your equal low breakdown, maybe it is 201, right? So it would be this, and then your trend would continue lower. So Tesla's still thinking about downtrends here, but those are the situations I would be mindful of. JP Morgan, we talked about on the financial sector, how this is kind of in a pain point for the markets. No love at the inverted head and shoulders neckline. You got it once on the first pullback, great, new higher high, but this time you've got a lower high technically underneath the neckline of a double top. No love at the bottom end of the balance. As a matter of fact, you gapped under it on that Friday session, and again, strong close underneath. So sellers can achieve a number of things here. Anything below at this point, 209.50 has to at least get you neutral on JP Morgan, if not just outright bearish, looking for a lower high rejection here. So that's my take. I don't know that I would be a new money short coming into this area of support on Monday. So if the market opens here and dribbles lower, I'd be thinking about possible counter trends off of 195, right? You can see how important this has been as an inflection point in the past. Sort of led to that breakout here. So 195 would be that watch. But again, your lower high on the daily anywhere below 209.50 is sort of detrimental for anything more constructive. If we look on the hourly time frame chart, change in tone. Let's take a look at Netflix, what's going on with the awful price action that we know is Netflix. Tried to break out of the falling wedge, failed, and lower like everything else. So at this point, it might start to play nicely if sustained lower highs can persist below 622. Notice this sort of H pattern here. So if you get an equal low breakdown under 607.60, there's some room to fall through this thin structure all the way to the top end of this previous earnings balance range at 578.50. So this downtrend or just short trade could make sense here. Under 607.60 trades into 578.50. And last but not least, we've got AMZN. What's going on here? Daily time frame chart before we move on down to the hourly. Bearish 3-bar play. When's the last time we had a green day on AMD? What is it? Back in July. We can say that now. Back in July. It's August now. Anyways, lower high here on the earnings gap up. That was about as classic as it gets, gapping right into the overhead supply. NVIDIA was the better trade to take, but regardless, you get the point. So rejecting, again, bears are in control. Bearish 3-bar play just means underneath these lows, trade the next target. What do we have structurally? I want to show you where it's coming from. This is thin structure. That is a thin structure retracement all the way into 124.50. So underneath this area, notice the rejections here under 135. If this sticks and we get an equal low breakdown, this should be a, air quotes, easier trade for the market to pull off. Nothing's ever easy in the markets. I don't want to try to mislead anybody, but it should be easier compared to difficult because of what we just saw on the daily with this thin structure through the breakout, right? Coming into retest, that previous resistance now is possible support, 124.50. So watching for that. Where would I be bullish? You got to show me a double bottom Brigade bolt over the neckline, 135. If we get that, maybe, but still thinking about counter trend, thinking about lower highs, that could emerge at a stronger retest, which would just be I would still be bearish if this is what emerged here, bear flag, right? So under 153.75, I think you're hard pressed to really build more of a bullish stance here on the semiconductor AMD. All right, couple of ideas for you. Speaking of semiconductors and earnings this week, we have SMCI. It's really more of a check-in on a trade idea and thesis that we've had. Remember that we called this the heartbreaker trade, where we've got some puts underneath 708, and that's continuing to play out. I think that your next watch here, if you're not already in, is setting a lower high, and I'd probably wait for earnings to pass. You could get some long-dated puts, which is sort of the approach I took, and we'll just sort of monitor those. But lower highs that persist here, I think that you're going to lose, I think that the AI hype is already being downplayed by some of the mega cap tech. I think that NVIDIA is the clear winner based on spend from companies like Microsoft. It's getting all the love. AMD is clearly a display of that. So I think that super micro wouldn't be unreasonable to sustain a downtrend or a lower high below 708 even on earnings. Now, typically don't speculate on earnings, which is why I have really long dated puts. And it's not like we're going to go to zero in the next week if we're wrong. So that's SMCI, still in play as a bearish trade. Next up is UNH, still in play as a bullish trade. This is what we had headed into the Thursday-Friday session, and the breakout's actually persisting into blue skies. We talked about the failure from the sellers to really rotate through the thin structure, taking that as a bullish clue, and this breakout did come into play on Thursday-Friday. It's going to persist here as long as we're over 580.35, so continuing to watch that for additional longs. I am not holding anything in UNH, just to be transparent. I am holding the SMCIs. Let's go to Oracle as our next idea here. Overhead supply getting absolutely heavy, weighing on this into a gap. I mean, on Friday's session, gap down. Yes, a bit of a counter trend move, but the opportunity here is like, say you don't want to trade SMCI, you still have a heartbreaker trade in Oracle on any lower highs that persist underneath 137.50. So continuing to watch this, and I'm really fond of the gap structure almost being equivalent if we just go back to SMCI. As it's not technically a gap, but we had thin structure through this rally when it was AI Mania 2.0. So that's Oracle. And then lastly, it's MMM. And I don't think I actually put the drawing set in here. I didn't. We have an inside bar, but really it's just bullish consolidation up here at these highs post earnings. And there's no sort of pain points relative to what the broad market did. So I would monitor this for possible continuation to the upside if the broad market sees a counter trend move. There's a huge if attached to the MMM trade. If the broad market moves higher, namely the S&P 500, not as concerned with the NASDAQ, obviously, but if the S&P is bullish on Monday for a counter trend, I would look to the 3M, MMM, as a possible bullish trade breaking out of a very textbook bull flag. If it breaks down below the inside bar low and the broad market's still falling off of a cliff next week, wouldn't be unreasonable to try to take a short here underneath 124s. That could be an outcome out of 3M. That's going to do it for today's episode of the Weekly Watch List. This was a long one. We included monthlies in a single take, some additional charts for the fundamental supporting evidence. If you enjoyed the video or learned anything new, let me know down below in the comments section. If you enjoyed some of the additional I felt like I was a little bit looser with the commentary. If you enjoyed that, let me know down below. I'm always trying to seek improvement for the channel and make sure that these are of much value to you as they can possibly be. For me, they definitely serve their point in terms of preparing for the week ahead, walking through these thoughts, verbalizing them. It's a huge help for myself. So again, thumbs up button goes a long way. Drop a comment, subscribe if you're not already. And I wish everybody a green trading week. We will see you in the pre-market prep up in the penthouse Monday morning at 8 o'clock sharp. See you in the next one.